This is Street Signals, a weekly conversation about markets and macro, brought to you by State Street Markets. I'm your host, Tim Graff, head of macro strategy for Europe. Each week, we talk about the latest insights from our award-winning research, as well as the current thinking from our strategists, traders, business leaders, clients, and other experts from financial markets. If you listen to us and like what you're hearing, please subscribe, leave us a good review, get in touch. It all helps us to improve what we offer. With that, here's what's on our minds this week.
Even if we're a service economy, our reliance on AI means we have to produce more energy to get that extra boost that's supposed to come from AI.
That constraint, as well as the competition, is one I'm wondering if you guys have thought about, and what level of energy price inflation consumers might be prepared to deal with in exchange for productivity benefits.
That's a fundamentally political question. What I think is interesting is that as we speak in late 2025, you have politicians in the US and even one or two in Europe now starting to talk about this issue and to side with households, because households have more votes than data centers.
Questions of global competition and the trade-offs those competitions entail dominate my discussion with this week's guest, Elliot Hentov, Chief Macro Policy Strategist at State Street Investment Management. Whether it's competition on trade, competition in technology, competition for capital in an era of rising debt levels, these are all incredibly complex questions that carry significant implications for investors. Elliot and I managed to get through what I think are the most important ones. This is a really far-ranging discussion this week. It offers plenty to think about as far as what it all means for the investing landscape in the coming months. We do make some time, though, for the personal, and we open with some thoughts on the podcast, as well as my recent trip to Brazil.
Hey, Tim.
Hey, how's it going, sir?
I guess you're only one floor beneath me.
That's true. One day we will have a studio. We could do this there.
Well, you do. That is the mic, right?
This is yeah. This is the mic where it all happens.
So you already have the microphone. You have something. You're not fully bare.
No, but it is probably the most budget podcast you've ever seen in your life.
Yeah, although I think it probably price to value is probably one of the best podcasts in the market.
Oh,
or the ratio of resource to quality to resources put in.
Yeah, sadly I think that's entirely a function of the cost as opposed to the output. But you're very generous.
You know what's crazy? I actually think you're starting to get known as the Street Signals guy.
Yeah. Well, I was in Brazil last week. I was introduced. It's like, oh yeah, we listen. Yeah. Okay.
Oh, you were part with Simona was there.
Simona and I presented back to back, and it was like perfect. Her last slide basically set me up to go into my stuff on alternative data, and it was just nailed it.
Well, what was your read on the whole Brazil vibe? I feel like Brazil's one of these weird countries this year that's kind of floating on a different cycle.
There's a few things going on. So like the local market perspective is good, but so it's really weird. Like Brazil has tons of hedge funds, but they are all effectively like mutual funds. So it's daily liquidity, daily marks. They can all see how each other are doing. And the retail class there loves hedge funds. They also can pull capital really quickly. And so when you have 15% local rates, that's what you're competing against. So they've found it very, very tough. Things are getting better, but it's been a tough 2 or 3 years because they're just competing with a riskless asset yielding 15%.
That's insane. And the currency has done okay.
That's the final read on it is everybody outside of Brazil loves the real. Everybody inside it is like, yeah, but, kind of, yes, there's a lot of carry to be had, but the first meeting actually was great because his mandate is to just take risk. And he's in, uranium and crypto, and he's, buying gold calls and just levering. I was kind of thinking, oh, this is going to be what the whole trip's going to be like, but no. He was the only one.
I think he'll probably still have a good year ahead. I think on balance.
Yeah.
On balance.
Let's get to it, shall we?
I can't imagine we'll get through all this.
No, probably not.
We have a nice roadmap, but let's just kind of see. This is less structured from my end, as in, let's see where the conversation takes us.
Yeah.
and you may have more editorial work than we usually do.
That's fine. It's good. It's already gone to a good place. So, actually, you brought up a good year ahead. I'm just thinking about how markets are trading very short term. And it felt to me when I was kind of throwing my thoughts together for you that it doesn't feel like politics or geopolitics is really driving things. I mean, we've had things like the government shutdown, which going in didn't really feel like a big market mover, and coming out now feels maybe like a modest market positive. But overall, my kind of hot take was it hasn't really mattered. That is politics or geopolitics. Would you agree with that?
We're just in the process of devising our annual outlook, and
Mm,
the section on policy is literally called a breather,
right.
because we had a series of shocks this year, obviously notably on the trade front. We also had it on the fiscal slash defense side of things by forcing allies to meaningfully ramp up spending. And we had the shock, or we're having the shock on the labor market front in the U.S. as well. So we've had a series of shocks, but we don't. If you look over this kind of 6-month horizon, I don't see any big shock. I see a variety of risks lurking, but no obvious shock. Whereas a year ago, you and I spoke around the election time, it was very obvious what was in the pipeline. That pipeline's now kind of dry. As a matter of fact, it's flipped, and there's a little bit of upside potential everywhere. If you look at U.S. fiscal, it should be moderately stimulative. U.S. housing policy could be moderately stimulative. You could get upside surprises in terms of policy in China and a couple other places in Eurasia and Europe.
I wanted to run with the trade one because actually in my introduction, that was the other one in the back of my mind when I was putting my thoughts together. A couple of weeks ago, right before I went away on my marketing trip last week, we had a series of agreements between the US and China. What looks like a massive climb down from the escalation we were seeing in April. And I'm just wondering, none of this is really binding. None of the kind of trade negotiations really are trade agreements as such. They are just agreements to de-escalate. And I'm wondering how you see this and how meaningful it is in your mind, particularly sort of the brinksmanship that got us to the point where we now see China willing to export rare earths, where that was looking like a big point of contention. Was that the kind of final folding of trade tensions between US and China?
I know we're caught up in the news, but I would really take a step back, try to look at the big picture here over a really long term, and then I think you'll see how I analyze the news flow.
Go. Yeah.
We had a bipolar system in the Cold War until 1989, 1990. Then we had a relatively clear unipolar moment that lasted arguably at least into the 2010s, perhaps even until 2020. And since then, we're in a transition. We're not entirely sure of what the destination looks like, but that old global order is out. It's one of the reasons we're having bigger and more frequent wars around the world. It's why we have a variety of friction in the system. So that's not only real wars, it's trade wars, it's fiscal wars. You have a variety of confrontation pent up because we don't have a stable order. Now, all I know is from history is that these transition periods are not long. They're highly unstable by definition because there's no equilibrium. It's not quite clear who's top dog, who's calling the shots, what are the rules of the game. And if that sounds a lot like the news of 2025, it's not a coincidence. And so the way I think about this more is how far away from that endpoint are we? The endpoint being a new, stable, equilibrium global order that we all kind of understand what's going on. I think the contours are becoming clear now of what that will look like. It'll still take us a few years to get there, and it'll still be bumpy. So this is not the end of it. I think we're heading towards a world where it's clearly the world gets kind of bifurcated with a big piece in the middle that basically trades, deals, works closely with both China and the US. They still have a complex layered relationship, but one fundamentally where power is carved to both sides. We're not there yet, but that's where we're heading. So to your point, this is not the end. This is just another milestone on that path. I do think it's going to be quiet for a few months, possibly even a whole year on that front until you get another source of combustion, another trigger of a crisis that, again, pushes the whole system forward towards some form of stable equilibrium.
I mean, you mentioned before in the first question, the massive disruption where geopolitics really mattered this year was in the first few months of the Trump administration. And thinking about the US-China dynamic, there was the belief, and it wasn't actually just around Trump, but the previous 5 years, really, as a consequence of the pandemic, this notion of deglobalization and upward pressure on the equilibrium rate of inflation, most notably. And so we're capturing some of the tariff effects directly by looking at price stats data. We talk a lot about that in our research. And it does look as though there's a leveling off of those effects. But just as a concept, is deglobalization at this point, I know we're kind of reaching this new equilibrium in the long-term future state, but have we hit at least the peak of the risk of a deglobalization scenario? And I'm specifically thinking about trading volumes here, which actually have not really retreated that much. And that's kind of the motivation for my question on that.
I'd be very cautious to call a peak on deglobalization, and I would have been doubly cautious on looking at world trade volume growth as your barometer for that. There's obviously a vibrant debate on this, but those global indicators are generic in a sense that they capture cross-border activity. So in that sense, cross-border activity is not in decline. But there is a major qualitative difference between trade done between Kansas and Xi'an province and trade done between Xi'an province and northern Vietnam. And I think a lot of that is disguised. So we do have, if we mapped a new indicator, trade volume by kilometer traveled between bilateral partners, I think that indicator would show a nice red minus, and probably for a few years already. And I think perhaps that one doesn't matter at the end if we basically have this new structure in the world where things get rerouted in a certain way. Maybe it doesn't matter and the overall effects are benign. And that's basically where we are right now. We're having deglobalization with the system digesting it and working its way around, processing it. So it's not coming in the form of a rupture. It's coming more in the form of a kind of a reshaping, kind of a river finding new ways. But I would be very cautious on peak. The other thing is you can always have a crisis that suddenly creates a rupture. There's no guarantee we end this decade peacefully in this kind of new reshaped trading environment. I'm certainly hopeful, but wars like in Ukraine can show that you can have events that deliver a rupture even if certain parties don't want that.
I mean, one of the main points of contention that is, I think, still affecting markets and that is making headlines really kind of as we speak is the AI competition between the US and China. So in the last couple of days, you had Jensen Huang from NVIDIA talking about China's role in the AI race and potentially winning it, which of course, so far, the US has, let's say, narrow supremacy. Is he right? Or is this just sort of a kind of a cynical attempt on his part to ensure the backing of the US? And we're very much in a US administration that believes in national champions and more intervention in the corporate sector than perhaps they would admit to. How accurate an assessment do you think that is?
He could be both right, and it's in his interest to say so. But I think for us analysts, the job is, and this goes, I've had the pleasure of talking to you a few times already. What I care about is what can I measure? What can I ascertain as a fact? That's really basically we're on the hunt for facts and data that corroborate things and that go beyond the speculative realm. And when I look at facts and stuff that I can measure, China looks ahead on most metrics. This goes from the ability to manufacture most of the value chain that makes up AI. It goes on the data that shows that the ability to scale production where growth is, the ability to, and the track record to build out infrastructure that supports it. On all those hard metrics, China wins. On softer metrics like patents, research publications, frequency of new innovations that enter the Chinese market, there too, China does look indeed stronger. I mean, there are a few individual parameters where the US looks ahead, and that obviously everybody knows that's a kind of like the very far end of hardware production in semiconductor chips. It's also on some of the very far end of innovation in certain areas. But for most of the indicators that I can actually measure and compare, China does look ahead. The one caveat, though, I want to throw in here is that we have this famous chart from a few years ago. Head to head, China looks ahead. But if I add the US in with all of its allies, both in terms of manufacturing capability and particularly all the innovative technology capabilities that its allies like Korea, Japan, the Western Europeans, Israel, etc., bring to the table, then suddenly the US plus its allies look ahead on most of the very, very same metrics. So the question geopolitically is like, who's ahead? Well, that's a function of how cohesive is the U.S. alliance? If the U.S. is alone, it's behind, and Jensen Huang is definitely correct to point that out.
That was actually going to be my question. I mean, how cohesive of a structure is the U.S. plus allies, and can that be maintained? Again, in a sort of, it seems as though we are in a zero-sum game mentality when it comes to trade, at least in the current administration. And is there, I guess, an interest in thinking about that higher purpose of the broad bilateral competition and maintaining those alliances, even if it means perhaps ceding some of the national status you, as the U.S., maintain?
It's a complex policy making exercise to pull all of that correctly off. Before the U.S.-China trade ceasefire, when you lined up all of U.S.'s trading relationships until mid-October this year compared to October a year ago, virtually all countries had improved their trading position vis-a-vis the US relative to China, and particularly allies. Allies, the improvement was actually quite a bit. The average effective tariff rate for most allied countries had improved somewhere between 10-15% vis-a-vis China a year ago. That's obviously no longer the case. That gap has narrowed, although it's still positive. So you can see in that, again, tell I'm hung up on trying to find things that I can measure and identify. But if you look at where's the actual effective tariff rate that countries are paying, you can see that the geopolitics matters. Basically, geopolitical proximity to the US gave you a better trade outcome on average. It's not a perfect chart, but it's relatively close on that scatter chart. It has a nice little coefficient. So I think the plan is yes. And if you then go beyond that, this week, for instance, the EU is discussing diluting and watering down its AI regulatory bill. You can see that basically most of the countries that have no geopolitical options have made their choice. And that is going to lead to eventually closer economic ties. You may not see it in the headline tariff rate, but that's not the only place where, cross-border activity takes place. There's technology transfer, there's cross-border investment, there's tax subsidies, there's visa favorabilities, all these things. And that's where you'll basically get the softer edge of trade integration, even for the US and its allies. And I think the lesson really of this year is that for all the bluster of a big unilateral America first presidency, the US is still one country that is very much nurturing and promoting its relationship with its allies.
Where does the energy aspect play into this? Because the U.S. is also the world's, now one of the world's largest energy producers, has access to plenty of cheap energy, and the AI race would seem to be really a race to do this most efficiently when it comes to energy inputs versus your AI outputs. What considerations do you have in terms of how to think about the competitive landscape and who is best poised to deal with what is looking like a binding constraint on the production of AI services and all the benefits that we expect from it?
I think if you really know the answer to that question, you can make a lot of money because the market is not sure. What I can tell you is that in our team, we've spent time this year, already at the beginning of this year, researching this, trying to understand, okay, there's a lot of CapEx flowing into AI. And then you think through, work your way backwards, the whole value chain of AI, and you'll start to identify that there's a gap somewhere. But if you start off with the ultimate end user who purchases the model output requires compute power. The compute power requires the data center to produce the compute. The data center requires the chips And until then, you can see, yeah, the money's flowing into all of this stuff: chips, data centers, the AI companies themselves, and the model development. But wait, the chips and the data center need to be plugged in to energy. And it's not, there's enough energy going around, but what's missing is, well, once you plug it into the socket, is there the transmission network in that area? Does it have electricity? Does it have a spare electricity? Can it handle these surges? Can it handle the cycles? Can the grid handle it? And then only track it back to where the power plant is and where the actual energy resource is feeding the power plant. And so what we saw is it's that middle section where money wasn't flowing. There's enough money flowing into energy, whether it's renewables, nuclear, and there's obviously crazy amounts of cash flowing into everything regarding downstream from data centers and chips. But that middle part, almost the boring utility section, transmission, grid, localized power plants, cyclical absorbers and buffers for different consumption patterns. There, the money was not flowing in, and I think that's my worry right now. Investors have woken up to it. Big private equity firms are now getting in, looking at buying utilities, expanding them. There's been a big regulatory push, but I think the cat's out of the bag. The demand, so to speak, for electricity is spiking before the supply can catch up. And that's going to be a real constraint. I do not know the story in China, other than the fact that they have been pursuing energy production at an aggregate level very aggressively for many years. So again, energy, the US does not lack energy. China doesn't lack energy either. I do not know whether China has set up its system in a way where it could basically get energy converted into electricity at the right time, at the right price. But certainly in the US, it's a constraint, and it's a real constraint. I think it's the one to watch. Maybe one thing I would say is that this kind of energy was very unsexy for many years because our economies became less energy intensive. Well, that's the famous lesson from the 1970s. We're much more of a service economy. We've kind of outsourced manufacturing, so our service economies weren't as vulnerable to energy price spikes. But I think the lesson now with AI is what you really should be looking at is the energy intensity of productivity growth. It's kind of a new indicator I'd like to invent, is to measure, well, how much delta in productivity requires what amount of energy intensity. And I think that number is actually creeping up because even if we're a service economy, our reliance on AI means we have to produce more energy to get that extra boost that's supposed to come from AI. So I think it's something to watch. Maybe it's an unsatisfactory answer.
No, not at all. I just wonder if there's a competition with the household sector as well that leaves the US consumer especially, but I guess global consumers, in an uncomfortable place where let's take the example of the Ukraine war, and particularly European consumers were impacted by that through the energy channel, if nothing else. Having a war on their border is obviously another big factor. And that kind of constraint as well as the competition is one I'm wondering if you guys have thought about, and what level of energy price inflation consumers might be prepared to deal with in exchange for productivity benefits.
Basically, that's a political question. That's a fundamentally political question. And what makes it even harder to answer is that the price sticker, as we saw in inflation over the last 3-4 years politically, that resonates, is very explosive politically. Whereas the benefits are distributed, vague, sometimes intangible, and some of them, of course, embedded with negative costs because they mean disruption and displacement. So it's an intensely political question. What I think is interesting is that as we speak in late 2025, you have politicians in the US and even one or two in Europe now starting to talk about this issue and to side with households, because households have more votes than data centers. And so I do think this is becoming politically salient. I don't think it will be in the very long run. In the long run, the infrastructure will respond. It's just that the elasticity is low, and so this takes a lot of time for the money to flow and to build out that. But for the next 5 years, I think this could be a very salient issue. But I think it's also a local issue because it is not a national phenomenon in any country. It's very distorted by where the infrastructure sets up and where the spikes in electricity prices occur.
Thinking about the other side of this, or at least when it comes to the Fed and their various mandates, the other side of their mandate, we've talked a bit about inflation and costs, but the labor market as well. And I don't mean by bringing up the Fed to make this a U.S. discussion, but the labor displacement from this technological advance. And specifically thinking, when I was in Brazil last week, someone brought up this notion of the jobless boom, which to my mind, I thought was a little bit crazy, or at least not sustainable, because, yes, it's all well and good to get growth without a concomitant improvement in the labor market, but that really can't last, I don't think. I mean, how vulnerable do you see things like social cohesion, the strength of institutions, in an environment where something like that happens? It's kind of the labor side of the cost trade-off you just talked about as being a political choice. Are societies well set up for that level of potential short-term or long-term labor displacement?
At this point, this is a philosophical question because the data is just not forthcoming. We see two areas in the jobs data that look like you've had a real AI impact. Everything else is speculative. And the one areas you see are, not surprisingly, it's the software engineering and coding. And so basically in the tech sector. And then you see it in editorial jobs, typically in media and communication sector. So that's where, if you go through the jobs data over this year and say like, hey, let's take out cyclical drivers, everything else, adjust, it looks like something has happened to these professions. Everywhere else, it's a maybe. A lot of the weak jobs number looks like it has a lot to do with the fact that we had a lot of uncertainty this year in first half of the year and until now. And uncertainty typically slows down hiring. It also slows down firing because, earnings hold up, but you don't know what's going to happen. So I think a lot of that can be explained, most of the weak jobs numbers or job growth numbers in the other areas. I'm not naive, but I'm somewhat on the optimistic end of this debate in terms of the labor disruption, partially because I've been working with companies trying to develop AI research, financial research, macro research that could compete with some staff members or labor. And I do not yet see a path towards a replacement. It looks like towards a path towards augmentation of employment, but that's just my narrow remit. But I have seen now, kind of accompanied some very pioneering research over the past 2 years. And the fact that 2 years in, I still am not convinced this will actually be heavily displacing I do think is somewhat of a tell. But the other thing that makes me very optimistic is that the biggest social cohesion disruptions is when you have broad swaths of a society that get hit. So it's like, think of the coal miners, the factory workers. So it's geographically, socioeconomically concentrated. They get hit with a whammy, and that has a widespreading consequences for social cohesion and politics, etc. Here, if you do get the disruption and it comes at a more tempered pace, it would be spread throughout industries, probably geographies, and as we know, skill level also somewhat distributed. Yes, this would not be it'd be somewhere in the middle and higher end of the skill spectrum, but it's not as concentrated. And so therefore the cohesive part, I'm a little bit more optimistic because I think both the pace and the distribution would allow for the labor market to recreate opportunities in similar areas. Actually, perhaps even less disruptive than the fact, where you're from, across the Midwest, the industrial Midwest, factories closed down en masse over maybe a decade, and that just left entire cities and regions without the anchor. If I told you, hey, 15 to 20% of the workforce in this region spread out across different educational and skill levels, we'll all find it hard and we'll have to find a new footing, but that new footing could be in the same town, in the same region. Then I think it's less toxic and less disruptive. But this is speculation. This is not hard fact.
Yeah. We have veered into the realm of the philosophical, which I love. I love it when when we do that. It's always nice to have the big thoughts. But there are actually a couple of kind of current events I wanted to cover with you as well. And I'm not sure where to really begin, but I think the one maybe right in front of us, literally today or last night, I guess, before we recorded this, was what looks like a folding of the Democrats' position on the US government shutdown. This, for me, was interesting in light of the electoral wins that, at least in the high profile races, and I think you could probably characterize the off-year election performance of the Democrats as pretty good. Where do we come out if you are the Democratic Party here? You perhaps have some responsibility, bear some responsibility for the shutdown, but now are contributing to its resolution. But then you have these clear electoral wins. What effects do you see carrying over into the midterm elections for them? Can they build on the positive momentum that they've experienced in the last couple of weeks?
The interesting thing about the folding is that it's not like the Democratic Party agreed to fold and end the shutdown. It's split. And if you look at the election results last week for the off-cycle election, the results were all split. You had kind of far left victories and you had centrist victories. I think that is the lesson to take away from the last few weeks, is that the Democratic Party is split. It's not quite clear how a split party fares in midterms. Obviously, we know structurally they should be winning the House back. Republicans have a majority of 2 seats, even with redistricting and a few other things. Historically, a president with Trump's approval rating should be losing somewhere in the vicinity of 25 to 35 seats in the House. But, the opposition party is still very, very much divided, and that creates openings for the incumbent party to make winnings. That's the key variable to watch, is whether party unity gets restored, both in terms of personality, but also around messaging. Because it's not quite clear whether the far left messaging actually has broader appeal, or whether it could actually be quite toxic and reminiscent of what the electorate rejected just a few years back.
And so would it still be your central scenario that the Republicans lose the House? And the part two of that question is, what does that mean for the second half of Trump's term? How much can he possibly get done if he loses one House of Congress?
I think he's clearly the exception to the political rule book. I do not think he enters any lame duck status. And in fairness, if you think about most of 2025, aside from the big beautiful bill and the fiscal stimulus, the bulk of the big shocks came from executive action and unilateral decisions of the presidency. Trade, labor, withdrawing the security blanket from allies, and so forth. Those areas remain very much under his potency. I think the second thing is that Trump is laying the seeds for Trumpism to survive, and his ability and his status as kingmaker will be greater than any political figure that I know in modern U.S. history. And therefore, I do not think he'll enter a lame duck situation. I do expect Congress to be divided, but we continue to be living in an era where the White House will make some very critical decisions, both for markets and societies.
Last week, we also saw some commentary, and maybe he's trying to read a little bit too much into the Supreme Court hearings on tariffs, but some hint that they might face a roadblock from the Supreme Court. Is this just a short-term obstacle to something he can accomplish with that executive power you referred to as still very much being within his grasp, even as a lame duck president, even with a loss in the Supreme Court on some of these IEEPA tariffs? Are there still avenues by which that agenda can be furthered?
We do not have evidence, again, I'm very much an evidence-based guy, that any of the institutional blocks that the Trump administration has faced, both in term 1 as in term 2, held up over time. That means it's like soil that's just been flooded. Eventually, it gives way. There is erosion. Yes, certain trees and walls may still hold up for a while, but the pressure eventually builds and the water seeps past. And that's the metaphor I'd use here too. I do not think any of these things are meaningful in the long run. I think the trend is very clear towards institutional erosion, less and less constraints on presidential power.
Do you think Trumpism can survive in the absence of Trump? Is there someone who has the dynamism and personal magnetism that he's clearly shown in pushing his agenda, and not just pushing his agenda, but winning over a party that in so many ways would have been hostile to some of his signature policies, say 20 years ago.
I don't think so. I think the coalition eventually falls apart, but I don't think it's instant, particularly if Trump is physically alive and present and a voice in the body politic. It can carry on, it can be transmitted to a successor for at least a few years. Eventually, the contradictions of that coalition will reappear and they will fall apart. But that need not happen on day one at the end of his presidency.
Something else on the calendar, and again, it goes back to this thesis I had at the beginning that, and that you've talked about as this being a bit of a breather, but where something that you would have thought earlier this year it was in focus, but isn't in focus as much anymore, but would have thought was in focus, were sovereign debt dynamics. And I'm thinking specifically here about what happened in France over recent months with all the political volatility. We still have a budget that has to be delivered, as well as the UK, where we will have a budget delivered. There's a lot of sort of kite flying in the media about various programs that Rachel Reeves is thinking about. Why do you think debt dynamics have gone away as a factor driving markets? It's not as though fiscal balances or outlooks have necessarily improved for any of these countries, and yet it's a far cry from 9 months ago, where everything you heard about was term premium.
Well, I'm still talking about it all the time.
Excellent. Why?
If you look at the G10, the countries where the term premium did rise the most this year, led by Japan, followed by France, Germany, France, UK. My joke is that all countries have had a new prime minister or new deputy prime minister this year. Actually, France actually had more than one switch. So I do think there's more happening than meets the eye. But death stories are very glacial. It's about a parameter. It doesn't really make a difference if a country's at 105 or 112% debt to GDP. It's not structural. So the question is, what else is happening in the world? What else is happening in financial markets that is very much in tandem? It's a dance between the two. The debt story has not gotten better. Financial conditions and the markets have improved in their favor a little bit. That's a temporary thing. This story about term premium and the worsening pressure that comes from the fiscal side will come back. You will have me back on here to talk about this in greater detail. And I will leave you with one thought on this. The one thing that is a dominant theme, and that's absolutely inevitable, is that the global story of safe assets, of government issuance, relative to those who need to buy them. So the net supply of safe assets is rising, and it's going to continue to rise year after year for the coming years as far as I can look into the future. That historically means a higher term premium, and it means historically that you do get moments of crisis. I can't tell you when, because that is a function of market conditions, but that is undeniable. I think the big story this year is really to say, well, hey, the US really it didn't show up in the US at all. It showed up a little bit elsewhere. That story could also flip in the coming years, depending on where market conditions and liquidity moves.
We're definitely going to be talking about this again. We will definitely be having you back on probably very early next year. But I was wondering if we could bring it full circle. You also talked about this maybe being a bit of a breather for politics and geopolitics and not seeing much on the horizon. But I did wonder if you had a thought for next year in terms of an investment idea, given some of the things we've talked about, or anything else that's kind of on your mind that you're thinking about for the coming 12 months that represents a really good opportunity for you.
At the core, I'm with the consensus. I still like stocks. The global economy recovers while rate cuts in the US, one or two more, proceed. That's usually a good backdrop for risk assets of all kinds. I do think over time, the dollar begins to weaken next year. And I don't like, as you can hear from my previous remarks, I do not like long duration assets, particularly bonds. That said, I think the most interesting, exciting parts is who can understand and spot which parts of commodities are in for a longer run here and which one have just been subject to speculative frenzy or geopolitical hedging. And I think there the story is still out because we do not know fully in each of these metals complex what the supply elasticities are, and to what degree technological innovation will value one or the other over time. And so I think that's really where you can have a very interesting alpha opportunity if you delve deeply.
You have good company in that view. Anybody who's listened to the last couple of weeks of episodes of the podcast will know that that is effectively the view that we have. It's the view basically I have. So another longer term breather when it comes to geopolitics is no bad thing for markets. And it's no bad thing to have you on. And as we mentioned, you will definitely be back on very soon. Elliot Hentov is the Chief Macro Policy Strategist at State Street Investment Management. Elliot, it's been a pleasure to have you on and to chat again.
Thanks a lot, Tim.
Thanks for listening to Street Signals. Clients can find this podcast and all of our research at our web portal, Insights. There, you'll be able to find all of our latest thinking on markets, where we leverage our deep experience in research on investor behavior, inflation, media sentiment, and risk, all of which goes into building an award-winning strategy product. And again, if you like what you've heard, please subscribe wherever you get your podcasts and leave us a review. We'll see you next time.